Hi everyone, Sean Humphreys here. Welcome to All Things Retirement. In this installment, we're going to talk about how your stock portfolio is taxed. This is part of an ongoing conversation we're having on stock portfolios. So we'll talk about how you reduce tax, defer tax, or eliminate tax on your stock portfolio. And so there'll be some very helpful hints that you'll want to take advantage of. Now, this is one of the main reasons that people will have stocks in their portfolio is not just the compounding of value over time, but also trying to reduce tax each and every year. Now, if you're new to our channel, make sure you hit the subscribe button and the notification bell. We're posting content all the time, quite literally in all aspects of retirement. So if you don't want to miss the future installments on this series on stock investing or other content that we upload on a regular basis, make sure you hit that subscribe button. Okay, let's talk about stock investing. So the first thing we'll take a look at is two areas. One is the dividend tax credit and the capital gains exemption. Now, those are the two main ways for what are called non-registered portfolios that we can reduce tax. So let's go through that and we'll talk about some of the basics around the Income Tax Act in this area. Now, the first thing I'll do is just take a look at stocks and taxation, and we'll take a look at it by looking at this tax calculator. Now, this tax calculator is part of a suite of calculators that you can access through our website. So let me just go to my website very quickly and show you how you can access these calculators. Okay, this takes you to the Asante Wealth Management Humphreys Wealth Group website, and if I go to the toolbox here, just click on toolbox, it'll give you this page. Now on here we also have listed some of our playlists from our YouTube channel on various topics, and then down here you'll see the online financial calculator. If I click there, it'll bring you to the home page for these calculators. So there's calculators on cash flow planning, net worth, education funding, the tax benefits and RSP. In retirement planning, we've got an inflation retirement income calculator, how long will your money last calculator, RIF payment calculator, and TFSA versus RSP calculators. Under investment taxes, we've got a whole bunch of categories, savings and growth, cost of waiting to invest, real rates of return. So some great calculators. Make sure you go to the website and then get to tools, click the link, and you can get to this resource. Okay, let's go back to the discussion on taxation on our stock portfolio. Okay, so what you see here is the tax calculator. Again, go to humphreyswealthgroup.com and you can find the calculators by going to the toolbox part of the website. Now, this particular calculator, we're using the province of Manitoba, so you can pick the province on the drop-down list that you reside in. We're using $85,000 per year of taxable income, and you can see that the calculator gives you the marginal tax rate at 37.9%. So for every dollar you earn at that level of income, 37.9% of your income is taxed. Now, that doesn't mean that all your income is taxed at that rate. We have a marginal tax system. So up to roughly $47,000, $48,000, there's a level of tax. From $47,000, $48,000 up to $90,000, there's another level. So there's various marginal tax rates, and you'll pay different levels of taxation based on those bands of income. So taxes payable on $85,000 would be roughly $22,327. So the net income is $62,673. So in this analysis, we're not assuming any credits, deductions, that kind of thing, just a basic tax calculation. Now, another way of looking at it is average tax rate. Average tax rate is simply taking your tax payable divided by your total income to give you an average. So the average tax rate on that level of income, $85,000, is 26.27%. So for every dollar of income you earn, roughly about 26% goes to taxation between federal and provincial income tax. Now, this is where marginal tax rates get interesting, because you really want to compare the efficacy of various tax strategies for investing by where you land on the marginal tax rate. So for now, we're going to talk about non-registered investing. And so this is money that's held, let's say, within your corporate account or your personal open or non-registered account. And so you're getting T-slips. So you're getting tax slips, T3s and T5s. So if you get interest income, interest from your GICs, your savings accounts, your bonds, as an example, that's treated just like regular salary income. So you're taxed at 37.9% of your interest income goes towards taxation. Now, if you receive capital gains in your portfolio, and that's one of the benefits of stock investing. In other words, if I put $10 in a stock and it grows to $20 and I sell it, I've got a $10 gain, and 50% of that gain is taxable. So that's called the inclusion rate. So you can see on capital gains income, it's taxed at 18.95%, when you take into the fact that only half your gains are taxable. And then you have what are called eligible dividends. So eligible dividends are income paid by your stock portfolio. So we've talked about the fact that stocks give you the potential for price appreciation, but they also pay quarterly income typically. So if you look at a blue chip stock or a quality stock, it's paying quarterly dividends to you. And at the end of the year, you'll have T-slips that summarize your dividends. And there is some tax relief through the dividend tax credit system. So it's not as beneficial as capital gains, but you can see here it's taxed at a marginal rate of 20.53%, 18.95% for capital gains. So in both these categories, stocks are giving you a pretty significant win over interest income that you might be receiving. Okay, so that's on the non-registered side of a portfolio. The reason you want to have stocks is to leverage off the capital gains exemptions or the dividend tax credit. So I'm not going to go into those two areas in detail today. I just wanted to give you an example of what the relative benefits are of those sources of income from a stock portfolio. So let's look higher level and talk about how TFSAs are taxed, RSPs are taxed, and open accounts are taxed. So we've already talked about the open account. So the open portfolio basically leverages off the dividend tax credit and the capital gains exemptions. Now, if we look at the tax-free savings account, which should be a foundational account for you in your planning, you can see that when you put money into a tax-free savings account, there are no credits, there are no tax deductions, unlike an RSP account. However, very powerfully, all income is accumulating or growing on a tax-free basis within the tax-free savings account. And then when you pull money out, there's no taxation on redemption. So over time, the tax-free savings account is very powerful because of the tax-free compounding, and it doesn't impact you negatively in terms of income when you take the money out. So, there could be some supplements, benefits, tax credits that could be negatively impacted by other sources of income, and the tax-free savings account doesn't interfere with any of that, right? So one of the main things I say to clients, for those assets you do not need immediate liquidity of, make sure that within your tax-free savings account you're leveraging this tax-free growth by putting growth assets like stocks in your portfolio. Because if you've got a savings account or a GIC paying you 1.5%, 2%, you're not fully harnessing the tax-free compounding power of the tax-free savings account unless you're putting a balanced or growth portfolio in place. Now, as many of you already know, with an RSP account, again, here's our box. When you put money into the account, so I've put $1 in, I'm going to get a tax deduction. So if I put $1 in, I'm at the middle tax bracket. We'll say for discussion purposes, roughly 40 cents on the dollar is going to come back in terms of tax savings. And then that money is going to grow on a tax-deferred basis. So it's not tax-free growth, it's tax-deferred growth. And then when you pull the money out, it's going to be taxable to you. Now, what I typically see in the media and comments from all kinds of people is, I wish I'd never made an RSP contribution. I'm paying more tax than I should be, and it wasn't a great deal. And I don't weigh into those conversations necessarily, but here's the reality. For most people, they're pulling money out of their RSP accounts or RIF accounts at a lower tax rate than the deduction value they receive when they put the money in. There's quite a few people in situations now, particularly where you can income split the income on RSP or RIF withdrawals, ultimately, where because you can income split often with a spouse, if you have a partner, many people were getting deductions at least 40% marginal tax rates for their RSP when the money was going in. And I'm routinely seeing, income taxed at, let's say, 25%. For a family earning roughly $90,000 to $93,000 a year pre-tax, they're at the lowest tax bracket. So RSPs are valuable. They should be looked at strategically in terms of your retirement plan. So when you have a stock portfolio, you're able to defer, obviously, the tax. Now, we already talked about the open account, so there's no tax benefits when you put money into your open portfolio. All the growth is taxable, and if you have stocks in your portfolio, you're going to get dividend income and capital gains income over time, and that can be a capital gain or loss, and then dividends. So the big takeaway on this video is that when you are investing, if you're trying to keep more of your hard-earned money, particularly as it relates to a non-registered portfolio or open account, your corporate account, you want to make sure that you leverage off the power of stock investing by taking advantage of the capital gains exemptions and the dividend tax credit. Well, that concludes our review of taxation as it relates to your stock portfolios. I hope that you found the content helpful. So again, if you haven't subscribed to our channel, make sure you do that right now and click the notification bell so you're alerted to future content on this topic and other retirement planning topics. Anyway, wishing you all the best in your retirement planning and wealth planning journey. You take care. Bye-bye.